we're getting more leads that come in on deals that maybe we wouldn't have had the opportunity to look at before. So I think there's people exiting the market, and I think it's freeing up us to be able to make moves that maybe we wouldn't have before.
I don't understand necessarily where it can go. I mean, obviously the 3D printing is going to be really expensive, so that's not something that's going to be a short-term play. No one's going to leave. Not a lot of people are going to leave their unbelievable rates they fixed over the last couple of years. That's going to be tough. But the supply, but there's nothing out there. The population, like you said, increase is faster than the ability to, or the building, or the providing of homes to move into. And even if people try to catch up, the cost to build those homes, this is going to be very interesting. So I think the best way to look at it is maybe just to be extremely cautious. Maybe not going to be as easy over the next couple of years.
Yeah, and I think, this is the type of climate where I think people are trying to hold their breath and say, where are we exactly? And then when the dust settles a little bit, if the Fed's like, okay, we're done with interest rate hikes, I think then we'll see some activity pick up and people will kind of like take a collective breath and say, okay, this is the new normal. Now they'll start making decisions on selling their home and moving into a different one. And maybe you'll see some investors that pick back up with buying activity. But
okay, so now that we've looked in the crystal ball and looked at it 78 different ways, what is the answer to the question, what is Red Ladder going to do differently over the next 6 months, do you think?
Underwrite more carefully. I think there's going to be more deals on the MLS that get stale. So I think we're going to basically implement more of a on-market offering or an on-market strategy of supplementing our deal flow. And I think there's going to be a void now, we didn't talk about this, and we won't have to belabor the point, but they also recently outlawed wholesaling in the state of Nebraska, where you can get stiff fines if you have any marketing of equitable interest in a property and you're not a licensed agent. That is creating opportunities for a business like mine. We're not licensed agents, but we close on every deal. We don't wholesale. So we're getting more leads that come in on deals that maybe we wouldn't have had the opportunity to look at before. So I think there's people exiting the market, and I think it's freeing up us to be able to make moves that maybe we wouldn't have before. So I think we're also going to have foreclosures, and they're going to start ticking back up again. So that's going to, we haven't seen foreclosures like they were in 2008, 9, 10. That was everything I bought back then. I haven't bought a foreclosure since Nam. I don't even remember the last one I bought. It's just weird. So I think we're going to have a different climate with those things coming into the forefront.
Do you create any contingency plans on the assets that you're purchasing and possibly flipping? Because rates have just been increasing, and in a couple months from now, we could get another rate increase and a big bump, which then reduces the value of your asset. This is why Chris and I like the buy and hold, and so do you as well, of multifamily, is we can ride out the interest rate hikes. Although the paper value of the asset technically goes down, we still have the same debt as we did before. We have the same terms, and we're likely increasing the rent along the way. So we're still okay because of the terms that we actually locked in. So with Red Ladder, when you're doing your underwriting, are you upping it? Are you looking at the interest rates and upping it by a point or two, or how does that look?
How do we stress test it?
How are you stress testing it? And what happens if you do have to keep it? Say it becomes a dud. Do you go from a wholesale, or not a wholesale, a wholesale to a flip to a buy and hold model, or where's the?
Yeah, that's a great question. And in different environments, so like when you look at the economy as a whole or the housing market as a whole, in times like this, you have spiking interest rates, low housing inventory. You've got low foreclosures, low evictions because of the fallout from COVID and a lot of the government programs that were put out. And if you look back to, say, 2008, 9, 10, that was a completely different environment where making certain types of moves made a lot of sense at the time. Wholesaling was not a thing then. You had to make, you had foreclosures everywhere. There were more deals than you could shake a stick at. It was just finding banks to finance you and having the cash available to do it, and then actually being able to sell your product for what you think you could, because there was more time on market, more inventory. And at that time, you had to flip. So you couldn't just buy a property, clean it up, throw it on the market, and then it's a bidding war. It wasn't like that at all. You're lucky to get an offer, and you fought hard when you got that offer. So you had to do inspection, home inspections were on every single sale that you had. And you had inspection contingencies where you had to fix a bunch of little stuff at the end of the thing. So you're shelling out money, right? But you had to rehab a lot. So that's the difference in an environment where things are going well and there's zero inventory and there's bidding wars. You don't have to have a pretty house. So I think we've been, I wouldn't say spoiled, but we were making hay while the sun shine in the last, 4 or 5 years because the lack of inventory, people just making insane offers on stuff. So we just needed a house. It didn't matter if it was the house. Now, when you get inventory, to answer your question, we are very selective about which ones we're going to take and do a full rehab and sell to an end buyer. And we're looking at that very hard now. So I think the right properties will still wholesale and sell fine, but you have to have them in good areas. You can't buy in the hood now and have it be okay because everything's selling. So I think, rising tide lifts all ships, but in a market like this that's turning, the first thing to go south is rougher neighborhoods, the values. So being more selective about the neighborhoods, rehabbing more than we probably would have in the last couple of years, and dispositioning things that way so that we're protected on the back end by having a really good product compared to what everybody else has in the neighborhood. So those are the differentiators, right? And the ones that we do take into inventory, we're looking at it with a long lens of, okay, we have a specific part of town or a couple parts of town that we really want to be concentrated in around the med center. I've talked about this where they're doing, $2 billion, 10,000 job project there over the next several years. We want to buy as much as we can around there, higher end rentals, focus on the medical, tenant community and Dundee area. So we like both of those areas, kind of midtownish around here. So pick up more rentals along the way, flip more, probably less wholesaling, and take advantage of the absence of other wholesalers in the marketplace and do those things to fill the void.
But adjust, like that ability to adjust your investment strategy is huge, and it's not the same in a lot of sectors with people's money. That's for sure. Mm-hmm. That's awesome.